So let's take this conversation forward with Nilesh Shah. He's the perfect guy to tell us whether the stock pickers party is back, or this is more like a last hurrah before we reach some kind of a climax. Nilesh, fantastic to have you back. Every time I just realized we're matching completely. Championship, I may say so.
Nice, always to see the day starting off on a match. So great.
Nilesh, typically when you see this kind of a market where the index has seen a great return, you always see mid-cap stocks, they start catching up. Are we in for that kind of a pitch where individual stock pickers like you will now start outperforming?
Nikunj, I probably think that's the way the market direction is likely going to be, and that's how the set of opportunities are going to start coming up. And the reason for that, I think, are probably 2 to 3 prime factors, which I think will, in a way, drive the markets accordingly and gravitate it more towards the broader side of the market. One is, of course, that basically it's become now fashionable to start putting money through ETFs and through passive investing. And I think that when a particular strategy plays out really too well, it's probably towards the strategy starts to get mature and it starts to kind of, the law of diminishing marginal utility starts to play out. So my sense is that's the first factor. The second factor essentially is that the mid and the small cap space essentially is coming out of a very long period of underperformance. So if you broadly look at it, post 2017, 2018, 19, and to some extent very large part of 2020, these 3 years put together, the mid small cap space has underperformed. The third thing, of course, is that I strongly believe that we are now set for a very broad-based recovery in the economy and in terms of the GDP growth. So far, essentially, the capex cycle, the investment cycle, the discretionary spending by consumers, all of that had taken a backseat over the years. But what I'm now beginning to see are those initial signs of essentially the whole atmanirbhar program becoming more now followed up by a sense of atmavishwas among both producers as well as consumers. And so to that extent, that makes me believe that some of the sectors which represent the broader economy and which have underperformed, I believe will start to now kind of pick up. I probably believe that it's just the starting. The party has just started. And my sense is over the next maybe 2 to 4 years, you're really going to see this space kind of really march ahead versus the very obvious popular benchmarks and popular indices.
Nilesh, a lot of factors have to come together for the party to continue. The Cinderellas of the world are saying mid and small cap companies do not have the ability, capability, and the scale to grow. The migration is happening towards large companies. Whatever manufacturing schemes are coming, they would only benefit large players. Wherever market share gains are happening, they're happening because smaller players are losing market share. So while it's logical to understand that Nifty 50 has rallied, now the broader market has to participate. But can I argue back and say that this time I'm afraid the conditions are very, very different?
Well, what happens, Nikunj, typically is that if it's a mature sector, maybe the scale matters quite a lot and the bigs keep getting bigger and bigger. Versus that, when you basically see that the sector is likely to witness some kind of superlative growth or hyper growth, then of course, basically that lifts all boats. And I think that leaders, larger players, mid-sized players tend to essentially do well. The third, of course, thing is that when we kind of really talk of mid and small caps, we're talking more from a market capitalization point of view, but that doesn't mean that these companies are tiny. For example, you could pretty much have a company which is, more than 10, 12,000 crores of market cap, still get classified as a mid-cap company and not a large-cap company, but a 10 to 12,000 crore market cap is not basically small or mid-sized by any stretch of imagination. These are companies which could even have 5-10,000 crores of revenue. So to that extent, yes, from a stock market point of view and an investing perspective, you could classify these kind of companies as mid-sized, but essentially they too are leaders in their chosen space. And I clearly believe that that's where the opportunity lies. There is relative under ownership, there's relatively less tracking, and I think they have the potential to surprise in terms of growth. These are companies and businesses which could deliver growth in high teens or maybe even low double digits. And that makes them very, very interesting set of opportunities. And that's why I think that this is really the segment which is going to be the sweet spot over the next maybe 2 to 3 years or 2 to 4 years.
Nilesh, for the longest time we've interacted on this forum, there is one view which both of us have endorsed, which is that SBI is a relevant bank and it is a cheap stock to own. But look at what has happened. Despite valuation, relevance, market share gain, State Bank of India profitable subsidiaries, the stock is underperforming. There is a serious case to buy SBI, but yet Kotak and HDFC Bank, they outperform. Do you see that changing in 3 years?
Very difficult for me to really say that, Nikunj. I think it would probably still be very premature on my side because the bank is fundamentally sound. It's arguably India's largest, one of the most respected banks. So, and I don't see the bank kind of in a way falling short on all the operating deliverables, so to say. So whatever conventional parameters that you would really measure SBI on, I think it stands out probably as much as 10 out of 10. I think look at the power of its operating subsidiaries. I mean, you have SBI Cards, which is of course now listed. Then you have SBI Mutual Fund. These are essentially wonderful franchises, and so to that extent, I clearly believe that it's broadly overall excellent from an overall perspective. But I think the challenge is that investors so far have been really reluctant and hesitant to own state-owned businesses. Of course, historically they did own it, but obviously, of course, that tendency has come down. The days of low price to book, dividend yield, all those concepts essentially are now out of the window. So to that extent, I think investors still have been very reluctant. Now, how will that change over the next 3 years? One really doesn't know, because surely there is still a case for continued reforms in the banking sector, and more particularly on the public sector side of the banking space. And I think if those reforms do happen and if they continue to happen, then of course there's a huge opportunity for re-rating of the State Bank of India stock. But if those reforms do not happen, then my sense is that the stock will continue to be an underperformer relative to the other private banks.
Sure. What do you really see as a fillip to demand going forward, Nilesh? We're watching out, of course, for policy. We've been hearing the updates from the auto majors, for example, or from the real estate companies, and the data seems encouraging. But growth is still likely to be in those lower single digits as we slowly recover. Do you see a major release of any pent-up demand as such because of the vaccine news and positive sentiment, or do you see a much more staggered recovery in the new year?
It already looks like that the recovery is gathering momentum. I think this has essentially been part of the overall unlocking theme. And what it looks like now is probably the first round of vaccines are probably going to be released sometime early 2021. And you're now seeing companies actually come back, reach out to essentially their employees and telling them to now start kind of in a way getting back into the regular mainstream and all of that. So to that extent, I think that clearly you're going to see now in a way sentiment kind of improve quite dramatically. Confidence coming back in terms of individuals, families, and households. And I believe that these intangibles, I think, matter quite a lot more than some of the very obvious tangibles. And what are some of these tangibles? One is, of course, like what you mentioned, pent-up demand. Two is that maybe over the last 2-3 years, consumers have gone slow on discretionary spending, whether it is buying homes or buying cars. or buying anything else which is big ticket. My sense is that you're going to see pent-up demand coming out. There's already a fatigue or a wariness creeping in terms of people actually not going out there and buying a bigger home or buying the next car or things of that kind. My sense is that that's begun to taper off. You are actually seeing this in terms of the number of transactions taking place in terms of homes and residential property, real estate. You're seeing some strong momentum gathered from players like Maruti in terms of the demand, especially for H2 of this year. Third, of course, is essentially the rural economy is essentially on a massive upswing. There is an unprecedented boom out there in terms of a bumper monsoon, bumper harvest, farm prices. All of these things essentially have kick-started the rural economy. And fourth is record interest rates on the lower side. You basically now seeing home loans being available at maybe 6.5 to 7.5%. Probably the banker today would tap me for saying 7.5% because he's willing to offer it even at 6.75 or 7%. So, that's how it is. And I think this is, in a way, tempting some of the fence sitters to really cross over and essentially make that next purchase or make that next discretionary spending. So my sense is that there are several factors, both tangible, intangible, which are providing strong tailwinds to basically demand and an economic rebound. And I think that's something which has started to play out and will probably gather further momentum in 2021.
Okay, which is heartening to see, of course. I noticed some of the pockets that you're also, quite bullish on, Nilesh, include, for instance, the insurance space, AMCs, and some of these select picks, I think, where you do see a lot of opportunity. Do you see that becoming a larger trend as well going forward? Talk to us about the potential there.
So clearly, of course, financials have always been a favorite, but I clearly believe that within financials, it's really the non-bank or the non-credit side of the space, which I think represents a secular growth opportunity. And clearly, therefore, opportunities like general insurance, health insurance, life insurance, asset management companies, maybe exchanges. These are businesses which can potentially sustain a high teens kind of a growth rate and could have essentially capital efficiency and return on equity, which is at least in high teens as essentially the base. So you've really seen a situation where maybe for the next 5 to 10 years, these are businesses which can keep growing in high teens and still sustain a capital efficiency again in high teens. So my sense is that that's a very, very interesting opportunity. I don't see too many new players coming in this space. Consolidation has happened. The incumbents, I think, are strong and are getting stronger out there. So my sense is that you're going to see, and as of course, the Indian economy gets increasingly financialized, this is essentially the space which can actually do well. And most important of all is that this space does not run a balance sheet risk, unlike, of course, banks which run a balance sheet risk and will keep needing capital probably every 1 or 2 years to basically sustain the growth. So my sense is that I think in terms of both growth and capital efficiency, you've probably seen the bank side of financials probably in a way kind of peaking out, so to say. I don't think it's going to get better for them from here on. Whereas I think the non-bank, non-credit side of the financial space looks a lot more attractive from a medium to long-term perspective.
Sure. Nilesh, you just reiterated towards as to how lower interest rates are going to drive the consumption of home sales forward. Nikunj and I were talking about it yesterday. Periphery sectors, your paints, your plywood, tiles, sanitary ware.
When we met last, you said you bought into Cipla and you had a wonderful logic behind it, which is that Cipla is in the inhaler business. COVID is a respiratory disease. A company which is in inhaler business would benefit. Have you identified any such correlations which could be a play on what is happening in the world?
So I think we continue to be constructive about the pharma space, and I believe that again Indian pharma is coming out of a very long period of consolidation. Most of them have been able to sort out or are on the verge of sorting out their regulatory issues. So to that extent, we continue to like the large cap pharma space quite significantly. I think kind of, coming back home, clearly believe that home construction and construction activity in general is going to be on an upswing. And so clearly believe, and that's purely because, again, stemming from, a lot of the fiscal sops which the government has been giving out for buying fresh homes. Basically, again, the kind of sops which government is having to promote investment activity by lowering tax rates, and of course the whole atmanirbhar program of the government. And I think because of this, you're going to see a lot of backlog of inventory getting cleared out. You're going to see new homes getting constructed. You're also going to start to see new factories getting constructed, new factories, new godowns, new fulfillment centers, and a lot of the other general construction activity. So my sense is, and our view is, that building materials as a space continues to look very attractive. Of course, the conventional paint companies and all of that will do well. But one space which is looking extremely attractive is essentially the wires and cable space. And I think clearly out there, the demand, I think, continues to be very, very strong. Valuations are very, very attractive. These are capital efficient companies, debt-free companies. So to that extent, my sense is that this is now turning out to be a very, very interesting pocket to own and ride for the next few years.
Fair point. You've not owned Kotak in your portfolio. You've not owned HDFC Bank in your portfolio, but that is the differentiation which you always wanted to bring out on the table. But how would you position your portfolio, your client's portfolio within financials for next 3 years? Because this is one space, Nilesh, where we know it that migration will only go to larger players. We can argue about fantastic companies in other sectors which are large, but the writing is on the wall. What is happening in NBFC space? What is happening in the private banking space? What is the best bet for somebody who, let's say, wants to buy 1 or 2 financial stocks or 3 financial stocks for next couple of years?
Well, so we've owned HDFC Bank in this calendar year. We've essentially have invested in HDFC Bank, and that's essentially been a wonderful experience as valuations turned attractive around the COVID period. So I think we've owned HDFC Bank in this calendar year. But I think stepping outside of that, we think that in the bank space, I think IDFC First Bank, which of course we've owned for a very long period of time, but we clearly believe that it's gone essentially through the metamorphosis which it needed to go through. It's undergone a major transformation over the last couple of years. And we think that that's pretty well positioned. But outside the banking space, clearly our big bet essentially is ICICI Lombard. That's something which we've been, again, liking for maybe the last year or two. But I still continue to believe that general insurance, health insurance, I think has got a long way to go. Penetration still are in probably a meager 1 to 2% of GDP, which I think is extremely low. And I clearly believe that this is essentially a play which is done well even during COVID time. So they did well pre-COVID, they did well during COVID. So it's gone through, in a way, one round of a stress test. And even during that period, it's been able to sustain earnings growth of 20% and a return on equity of 20% without needing additional capital. And it continues to be the leader. It continues to gather market share. It took some tough decisions of like exiting the crop loan segment. So clearly, again, that's one space that we like significantly in the financial space.
Would you continue to avoid consumer staples? Because now time-wise and price-wise correction has kicked in the Nestle's, Britannia and the HULs of the world.
Well, what we've been owning in the consumer staple space, again, is we've been liking it. One is, of course, Zydus Wellness has been a stock we've been owning now for a long period of time, and we continue to like what they do, both organically and inorganically. They now have a wonderful bouquet and a much larger bouquet of products. They become increasingly more relevant to their consumers as well as to their channel partners. And then, of course, they continue to address business adjacencies, getting into new geographical areas, doing several brand extensions as well, launching essentially today's products or the next generation products, things like chocolate butter, mayonnaise, and all of that. So clearly, this is something which we've owned, we've liked, it's done well for us, and we still think that the best is yet to come for this company. So we've been constructive on consumer staples and we like it. It's just that we've owned some of the niche areas. The other in consumer, if you would call it, it may not be a staple, but it's still a consumer play, is essentially in the alco-wave space, and we've owned Radico Khaitan now for some time, and we continue again like for what the management continues to do in terms of being able to essentially drive growth profitably, generate cash flows, deleverage themselves, bring down debt significantly from maybe 800 to 1,000 crores a few years back to now maybe about 200 crores. They continue to essentially drive the premium part of their portfolio. That as a percentage of their own revenues has been inching up, which is driving margins. And we think that they basically have got the right business strategy and which seems to be working well. Valuations are reasonable. So to that extent, I think we continue to like this. So these are some of essentially our top picks in the consumer non-discretionary space.